Good afternoon, folks. It's the weekly wrap-up for Friday, January 28th, 2022. I hope everyone had a fantastic week out there in the interwebs. It's a beautiful day here in Colorado. Finally, the snow has decided to leave us for a few days. So it's kind of been snowy, sunny, snowy, sunny. So it's coming back and forth. Got to use the snowblower for a third time this week. It is very exciting to smell like I've been mowing the grass. So it puts out some terrible exhaust. But anyways, like I said, hope everyone had a great week. If it's your first time watching one of these videos, be sure to subscribe, also like and share with friends and family. And because I'd greatly appreciate it, because I know there's probably a lot of people out there who are wondering what the hell's going on in the world. You know, what's going on with the markets, what's going on with the economy. You know, they're not always the same thing. You know, they are correlated in some ways, but they are two different animals. So all right, well, let's go ahead and jump in and take a look and see how the indexes did today. The Dow Jones finished up 1.65% to 34,725. The S&P 500 was up 2.43% to close at 4,431. NASDAQ was up 3.13% to close at 13,770. Small caps are up also 1.77%. The VIX was down 9.28% to 2766. So that's some good news going into the weekend that the VIX is finally back below 30. Let's see how things were across Europe. Lots of red. The only green I see is the S&P BMV IPC. All right, going down into the Asian markets. Looks like the Nikkei 225 and the S&P ASX 200 were the only two Asian, well, of the major ones that were up. Most of China was down, same with New Zealand, and then we had a couple of up positive ones down here at the bottom. But for the most part, it looks like for business day, January 28th, if you were to look at it on a global level, most of the indexes were down except here domestically. All right, well, let's take a peek and see how they did for the week. The Dow Jones, let's see here, finished the week up 1.92%. The S&P 500 up 1.73%. NASDAQ finished up 2.05%. Dow Utilities, let's start up here, finished, looks like it was negative 0.32. And the Dow Transports, our last one here, finished at down 0.80%. So, looking at, most of these indexes for the week, started out on a negative note, by midweek had reclaimed that, and then we've had a lot of volatility the last really 2 days, Wednesday and Thursday. So, we'll see where this goes. Looking at it on at a larger level, we can see here that the Dow Jones, the Dow Jones Industrial, the MACD indicator has now gone into negative territory. It did the same thing back in September through mid-October. For me, when this goes below this into negative territory, this is a fairly good sign that we have some turbulence ahead of us and possibly a retraction in the market. So I'm going to keep an eye on this, see if this lasts for more than just a day or two. Looking at the 2-day average, it's still in the positive. So, like I said, things are getting a little nervous, from a momentum perspective. So whether or not that's going to lead to some sort of a major catastrophe, looking back historically, when we've gone below this line, this was back in 2008. You can see what happened there. Obviously, back in the spring of 2020, when the COVID thing started, you can look here on this, on the weekly chart. Anytime it breaks below this line, it's typically a sign of some bad times on the horizon. So we'll see. On the weekly chart here, we're still quite a ways above the negative territory on the MACD. So again, we'll keep an eye on it on the on the daily chart, it's already crossed, but we'll see how things look in a few days to a week or two. All right, let's dive into the economy numbers. Initial jobless claims for this week came in at 260,000, right on forecast. Last week's numbers were revised up from 286 to 290, far above what the forecast was. The last 2 weeks we had been over forecast by 30,000 and 66,000. So it was not the first few weeks of January had not looked real good from an employment perspective. Granted, it could be holiday employment was letting go of staff, also with some people being off work for COVID. Who knows? All right. Continuing jobless claims, they came in at 1.675 million against a forecast of 1.650 million. So about 25,000 over forecast. I don't exactly consider that a tragedy. So last week's numbers were revised down from 1.635 to 1.624 million. Still over forecast by what is that, about 70,000, but certainly not the end of the world. Again, the longer term trend, we are seeing this heading in a southeast direction, so that is good. All right, the PMI Managers Index came in at a 55. The forecast was 56.7. So, what this means is that anytime this number is below 50, we see it's expanding. But you can see here that the general trend going back, more than a year, or I'm sorry, 6 months, is that this has been on a steady downtrend for, since last June. So we'll see where things go. Is this going to turn around, or, are we headed for, tougher times? The Consumer Confidence Index came in at 113.8 against a forecast of 111.8. So 2 points over forecast. As you can see, it still looks pretty stable in relative or in relation to the previous months. So I don't see a major pullback there. New home sales came in at 811,000 versus a forecast of 760,000. So again, a nice jump from the previous month. The last, looks like there was a bit of a slowdown for the numbers that came out in November. Those would have been October's numbers. So, but since October, we've seen a nice climb in new home sales. Durable goods orders, month over month, came in at a negative 0.9 versus a forecast of negative 0.5. So it was slightly worse than what was anticipated. GDP quarter over quarter came in at a 6.9 number. The forecast was 5.5. So that's pretty good. Again, we are coming off of a year of 2020 where everything just got discombobulated. So, obviously the numbers this year or for 2021 are going to look a lot better simply because the economy was more open. Things were moving a lot more freely than they were the year before. So there was a lot of pent up production in the economy that's kind of been escaping. So, that's what I would attribute that such a high number to. So, but looking back, the previous quarter numbers were around 2 to 2.3. Quarter before, ending in September, we had numbers that were 6.5, 6.6, and 6.7. So this number right now, the 6.9, is more in line with 2 quarters ago. But again, that's going to come back to reality at some point where it's going to normalize once everything gets pushed through the supply chain. All right. Consumer sentiment came in at 67.2. Forecast was 68.7. This is from the University of Michigan's Consumer Sentiment Index. As we can see, the consumer sentiment has been falling the last few months, probably almost going on a year now. The highest point I see here was last April. So since last April, we've gone from a 88.3 down to a 67. So granted, this is consumer confidence is just an opinion poll, but it does give a feeling of what the average Joe is looking at out there in the world. So, all right, I do have a couple of a few articles I want to breeze through with everybody here. So let's take a look at this first one. Oil hits 7-year peak on political risks, supply crunch. It's written by Swati Verma from Reuters. Oil prices rose to more than a 7-year peak on Friday and recorded their sixth straight weekly gain as geopolitical turmoil exacerbated concerns over tight energy supply. On a weekly basis, the benchmark contracts notched their longest run of gains since October. Brent futures rose 69 cents to settle at $90.03 a barrel after hitting 91.70, the highest level since October of 2014. U.S. crude rose 21 cents higher to at 86.82 a barrel after hitting a 7-year peak of 88.84 during the session. Tight oil supplies pushed the 6-month market structure for Brent into steep backwardation of $6.92 a barrel, the widest since 2013. Backwardization exists when contracts for near-term delivery of oil are priced higher than those for later months, encouraging traders to release oil from storage to sell it promptly. Major producers in the OPEC and allies led by Russia, collectively known as OPEC Plus, have struggled to raise their production levels. The market also reacted to attacks on the UAE by Yemen's Houthi group. Prices drew support from concerns over possible military conflict in Ukraine that could disrupt energy markets, especially natural gas supply to Europe. So far, there have been no supply disruptions in Eastern Europe, so guess the risk premium related to those tensions is not so high. UBS analyst Giovanni Stunova said. He added some investors still prefer to hold their exposure. U.S. crude futures did briefly turn negative earlier in the session. Matt Smith, director of commodity research at Clipper Data, said relatively softer U.S. rhetoric on Russia may have led to some of the air being let out of the tires on this crude rally. But the bigger picture here is with all the geopolitical uncertainty and the supply side concerns, prices are continuing just to get swept along. At its February 2nd meeting, OPEC Plus is likely to stick with a planned rise in its oil output target for March, several OPEC Plus resources told Reuters. This is because some key producers in the OPEC Plus group, including Russia, continue to struggle to meet their output quotas, said Marshall Steves, energy markets analyst at IHS Markit. U.S. production has struggled its way higher even as the rig count has been rising, Steve said, adding that output could be higher this year. On the demand side, crude imports in China, the world's biggest importer of the commodity, could rebound by as much as 7% this year, analysts and oil company officials said. So, looking at this, I would not expect any sort of relief at the pump or in energy prices until we start seeing the price per barrel start to go down and I forget how they track natural gas, what sort of units that, I forget. Anyways, doesn't matter. But until we start to see those prices recede and, cooler heads with the Russia-Ukraine situation resolve themselves, I would imagine we're probably going to have higher energy prices probably through the summer unless something dramatically changes. All right, let's see what we got next. Next story: Fed's matchmaker fear, flatlining economy meets higher interest rates. It's kind of like the stagflation of the 70s. This was written by Howard Schneider of Reuters. The Federal Reserve plans to raise interest rates in March. We know that. On the assumption the U.S. economy will largely steer clear of fallout from Omicron variant of the coronavirus and keep growing at a healthy clip. What if it doesn't? With financial markets fast adapting to expectations of an ever more aggressive Fed battle against inflation, year-end data showed weaker than anticipated results for some inflation measures of the U.S. Central Bank. Watches closely, a reminder of how uncertain its ultimate policy path remains. The numbers were still high, with the employment cost index, the broadest measure of labor costs, rising 4% on a year-on-year basis in the fourth quarter, the largest increase since 2001, and personal consumption expenditures price index jumping 5.8% on a year-on-year basis in December. The biggest annual rise since 1982 and nearly triple the Fed's 2% inflation target. But the pace of change from previous periods fell, and even as investors and many analysts continued penciling in more and faster Fed rate increases this year, some added a footnote. The slowdown in employment costs Growth, for example, was a big step in the right direction for Fed officials who expect price trends to ease on their own, said Ian Shepherdson, chief economist at Pantheon Macroeconomics, where Fed Chair Jerome Powell and other U.S. central bank officials have emphasized the risk that inflation may prove higher and require them to raise borrowing costs faster than expected. Shepardson, in recent forecasts, sketched an opposing view of an economy that flatlines because of the coronavirus pandemic in the first 3 months of 2022, loses jobs in January and February, and produces inflation that is falling sharply by the second quarter, just as the Fed is presumably gearing up for its rate increases. That scenario, out of step with investors who expect 5 rate hikes this year and some forecasters who have gone as high as 7, shows the degree of uncertainty still in play around where the economy is headed and how far the Fed will respond. No roadmap. An interest rate hike at the Fed's March 15th, 16th policy meeting is virtually assured at this point, but even the size of that increase is up in the air, as some analysts expect the Fed, rather than the usual quarter percentage point rate hike, opt for a larger half percentage point rise to tighten credit faster and demonstrate its seriousness in lowering inflation. Much, however, rides on how the economy, inflation, financial markets, and the virus behave in the coming weeks. Major U.S. stock indexes were trading higher on Friday, punctuating a week of heavy losses earlier in the day. U.S. Commerce Department reported that consumer spending fell in December, weakness that may have continued into January given the massive outbreak of new coronavirus cases. Consumer sentiment continued to decline at the start of the year, hitting the lowest point in a decade, according to the University of Michigan's closely watched gauge of American household sentiment. Survey director Richard Curtin said that the combination of Omicron, high inflation, and the steady dose of news about Fed rate hikes could trigger a consumer backlash, a possible blow to economic growth on top of what's already coming through lowered government spending. Government has lowered their spending? I wasn't aware of this. The danger is that consumers may overreact to these tiny nudges, Curtin said. That could help with inflation, at least some of which has been driven by strong demand for goods during the pandemic. But the Fed may be treading a fine line between what's needed to temper prices and what may be an overreach. Panic within the Fed's ranks has begun to set in. The challenge now is to tamp down inflation without allowing the flame on the overall economy to go out, wrote Diane Swank, chief economist at Grant Thornton, a professional services firm. There is no roadmap for doing this after inflation has surged. Bond markets on Friday were showing some signs of caution. U.S. Treasury yields fell, and the gap between longer-term and short-term securities has narrowed, often taking as a loss of faith in future economic growth, falling inflation, or both. Either way, said Minneapolis Fed President Neil Kashkari, it's reason the U.S. central bank may not ultimately need to slam on the brakes with aggressive rate increases. Yeah, he is someone who does not want interest rates to go up. He is very much in favor of keeping rates at or near zero. Despite the seemingly hawkish position of the Fed, Kashkari told NPR on Friday that the aim is not to restrict the recovery, but to let our foot off the accelerator just a little bit. Yeah, well, the problem is that the retards at the Fed are the ones who've caused this entire problem by bloating up the cash supply system and jacking up inflation through the roof. So you know what? This guy is such a moron. I know he's got an important job and he probably has a bunch of credentials and went to a bunch of fancy schools, but anyone who has that much education knows better than to flood the economy with cash and then stand there and go, "Oh my God, I don't know what happened. It's a complete mystery why inflation is through the roof." I mean, come on, people, pull your head out of your ass. Anyways, all right. Next story. Taxes 2022. Many Americans could miss this key tax credit. Written by Rhonda Lee. And this is from Yahoo Money. For the first time this year, millions of Americans may qualify for a particularly generous tax break, the Earned Income Tax Credit, thanks to an expansion of its eligibility requirements. Yeah, because people need more tax breaks. There are important changes to the EITC that will help this credit reach more hardworking families this year, IRS Commissioner Chuck Rettig said in a statement. We urge people potentially eligible for this valuable credit to review the guidelines. Many people each year overlook this and leave money on the table. Historically, without expansion, 1 in 5 Americans don't claim the EITC, prompting the Internal Revenue Service to hold an EITC Awareness Day each year. God, what a waste of time and money. this year on January 28th to make sure taxpayers don't miss out. If your marital status changed, you're a member of the armed forces, disabled, living in a rural area, a grandparent raising a child, or Native American, you may be eligible for this credit. More workers without children can also qualify for the EITC due to income threshold increases, filing status, and the look back election. Here's what you should know. All right, for seniors and young workers, in the past, the EITC for those with no dependents was only available to people ages 25 to 64, not for the 2021 tax year. Single filers without qualifying children who are at least 19 years old with income below 21,430 and joint filers with no children and income below 27,380 will now qualify for the credit. There is no upper age limit for claiming the credit if you have earned income. The maximum EITC for filers is also better, 1502 from 538 in 2020. New income threshold. If you filed last year and your income was just above the limit to claim this credit, know that the income threshold has been increased. Manuel Dominguez, senior tax research analyst at H&R Block, said in a webinar hosted by the National Consumers League, and you may now be eligible for this credit this year. The new income threshold also increased for married filing jointly who have children. In 2020, the income threshold was $56,844 with a maximum credit of $6,660. While this year, the income max is $57,414 with a maximum credit of $6,728. That's not a very big difference. You went from $56,800 to $57,400. So what's that, $600? I mean, jeez. Look back elections can help you qualify if your income in 2019 is higher than your income in 2021. The look back election using your 2019 income allows you to claim a higher earned income tax credit. Dominguez says to take advantage of this election, taxpayers must have earned income through employment or other sources. The look back election helps workers get a larger credit if they earned less in 2021 or received unemployment income instead of the regular wages. Other key changes. Certain changes to the law expand the EITC for the 2021 tax year as well as for future years. In previous years, the credit wasn't available for married filing separately. This year, going forward, those who file married separately can claim the credit if they meet other qualifications. Those with investment income up to $10,000 can get the credit. In 2020, the limit was $3,650. In future years, the limit will adjust for inflation. Last, filers with children can claim the credit even if their children do not have Social Security numbers, as long as the filers themselves have a Social Security credit. They qualify for the credit. In the past, they didn't. Expect EITC refunds by early March. If your refund is based partially or fully on the EITC, by law, the IRS cannot issue those refund payments until mid-February, even if your refund includes other credits not related to the EITC. This delay is to prevent fraud and errors. Yeah, because the government never has fraud and errors. I mean, they send out several millions of dollars to dead people and people living in Europe over the last couple of years. Let's see. For earliest filers, the IRS expects refunds to be in filers' bank accounts or on debit cards by the first week of March. Taxpayers can track their refund using the agency's "Where's my refund?" blah blah blah. So there's some good news, I guess. If you're, if you are someone who you would qualify for, you may get a little bit of an extra relief on your taxes. All right, and then one last article: RMDs may soon start even later for retirement plan savers. Investors may soon be able to preserve their retirement war chest for longer. The Securing a Strong Retirement Act, a bill originally pushed in 2021, but which may finally pass this year, would push the starting point for required minimum distributions, or RMDs, from 72 to 74 and 75. That means retirees could stave off being required to tap into their tax-deferred retirement accounts like 401ks and preserve their nest eggs for more years. This is on top of the news from earlier this month that the IRS is adjusting its actuarial tables for RMDs for the first time in 20 years in response to longer projected lifespans. That means retirees can take out less money at 72 under the current RMD starting age. The recent lowering of RMDs and the proposed delay of the RMD starting age are part of a trend to account for longer retirement periods and help retirees preserve their coffers throughout their golden years. These dynamics further enhance shifts that arrived with the 2019 Secure Act, which pushed the RMD starting age from 70.5 to 72. If you want to help planning your retirement and strategizing how to manage these changes, consider finding a financial professional, blah, 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 blah. All right. So we've covered a lot of this other stuff already. So if you want to go back and read that, feel free. It is attached in the show notes. So, this is not current law. This is something being proposed. So we'll see if that actually gets pushed through, depending upon what else is in that bill. If it's a standalone bill where it's just this, I have no problem with it. I have no problem with people keeping their money for as long as possible. But if there's other garbage in there that's going to do more damage to the country, then necessarily, I don't know if it's necessarily a good thing. So, all right, well, that's everything I had for this week. I hope everyone has a terrific weekend out there. I've only managed to ramble for 25 long minutes, and like I said, hope everybody has a great weekend. If anyone needs anything from me, or they maybe there's a topic or a subject you want me to cover, feel free to shoot me an email. Let me know. Otherwise, I'll be back on Monday with the weekly economic update. So everyone have a fantastic weekend. Bye-bye.